Welcome back friends to our grooming session for stock market beginners. This is video on different valuation methods for different type of companies. Let's start. So what is valuation method? A valuation method in finance and investment refers to a systematic approach used in determining the worth of value of a company, assets or investment opportunity. So it is the way to find out how to invest, when to invest, where to invest. These methods helps investors, analysts assess the financial health, potential future earnings and overall attractiveness of investments. Matching the method of the company. So different valuation works differently, right? So different valuation method used to depending on type of company, industry, stage of growth and available of financial data. Just like using the right tool, the best valuation method depends on the type of the company you are analyzing it. Here are the some popular method to the companies they are best suited for. Discounted cash flow. So from the help of discounted cash flow, we can generate cash flow in future, how much company is going to make money in future with the help of discounted cash flow. And it is best for the companies with a predictable cash flow generation like untitled established consumer staple companies and banking sector. Price to book value. So what is price to book value, friend? It is a ratio that compares company's market price to its book value. What is book value, friends? Net assets on the balance sheet, the true value of the company. It is best for companies with significant assets like banks, financial institutions, and it is a best way for real estate companies also. Enterprise value to EBITDA. If I want to purchase whole company, which market price I need to pay for that? It is called enterprise value. Enterprise value is the combination of market price, market cap plus debt minus company's cash. So the method considers company's entire value including debt. It is more useful compared to varying capital structure and high level of the debt. EBITDA is a direct indication of gross margin. How much company is making profit before deducting interest loan amount and all, and depreciation. Market multiples. What are the market multiples, friends? Like PE, PB, ROE, right? So this approach compares companies valuation method and best for companies with the publicly traded. Venture capital method. So you are all aware of the venture capital method. Right now we are watching one show on TV, Shark Tank. It is actually one kind of venture capitalist type. So traditional valuation method can be challenging and startups or early stage companies with the limited financial history and unpredictable cash flow here investor might rely on. First, what is venture capital method? This method focuses on the company's potential and the future growth and the market share, often using benchmark valuation on the similar startups of the same stage. Price to sales ratio. So what is price to sales ratio, friends? This ratio compares company's market prices to its revenue and can be alternative companies with the limited profitability. Valuation. Remember, friends, valuation is an art, not an exact science. So no single method is perfect, and the best approach often involves combining multiple techniques and considering qualitative factors like the overall market environment and the company's management. So valuation is the combination of art as well as science, friends. So we should go and deep dive in the valuation. It will help you to make your investment better and best returns. Stay tuned, friend, for the next video. Jai Hind.